I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guest we don't have near enough. He, along with Adam Taggart, founded peakprosperity.com. I'm talking about Dr. Chris Martenson. Chris Martenson, I just got to bring you on. A wonderful article you wrote, and it was titled, at least in part, and I didn't see this at first, Believing the Impossible. And I thought, what is he? Is he drinking the Kool-Aid? Is he believing that this is a real market? And then when you open up, if you look carefully, or maybe not that carefully, believing the impossible is necessary to rationalize today's bubble markets is the rest of the title. And I got to tell you, it was a fantastic article. And I just want to start with one of the metrics you brought up, where you took $2 billion market cap companies, which is a pretty big company, with a P to E ratio, price to earnings ratio of 50 or more, and what you came up with was stunning. Let's start there with this has to be, you have to be suspend all logic to believe that this is a real market.
Absolutely. And I started with that great quote from Alice in Wonderland everybody's familiar with, which is about believing 6 impossible things before breakfast. So I came up with 6 things that you really have to believe in or suspend disbelief in to really wrap your arms around this market and love it. And so the first thing up there was fundamentals don't matter, right? Of course they matter, but they don't seem to today. And so one of the ways we could detect that is to run that stock screen you mentioned. So take every company that's either got 2 billion or more of market cap and then a price earnings of 50 or higher. And what do you get? Wow, you get a list of 236 companies. These are not small little tiny things with, fly by night or huge growth prospects. These are big companies. And so what was really astonishing, Greg, was, we saw a pretty large number of those show up back in 2000 as well. But they were really concentrated in the technology sector, which makes sense, right? We all know about pets.com and Cisco and all that stuff happening. But this time on that list, what I take some effort to point out is you've got companies on there from the traditional high flyers. You got biotech, you got technology, IT, stuff like that. And you have things like food companies on there. You've got Yelp on there. You've got things from 21 companies from the oil and gas sector. So these are all sorts of different sectors. And so what we're seeing is just this caution to the wind. Fundamentals don't matter. And remember, if you're paying with a price earnings of 50, that means you are willing as an investor to buy a share in a company and wait 50 years for that company at current earnings to earn that dollar back. Not give it to you back in dividends, but to earn that dollar back. But 50 was the starting point. There's page after page on there of companies with PEs of 200, 300, 400, including some really giant companies. It's astonishing.
I want to go up to the next thing I want to just talk about is you talking about the Goldman. Oh, this is just something I just found myself. Goldman Sachs says the risk appetite is the highest on record. Would you talk about that too? It's the highest on record.
Sure, it's one of many things we have to also suspend disbelief about, that these records don't matter. Sure, we're familiar with that. The stock markets are making record highs. But what Goldman Sachs is talking about is a sentiment indicator that says it's kind of bullish. People have never been as confident as they are. Of course, when everybody's confident, that's when sometimes you get the turning points in markets. And of course, the last thing any bubble does is it sucks in everybody it possibly can. And so this is a really difficult time to stay oriented as an investor because sentiment is off the charts. What does that mean? A little technical. Goldman Sachs is talking about. It means when you go to a party, everybody around you is telling you how smart they are because they bought Yelp with a PE of 192 or something crazy like that, right? So this is just one indicator. But Greg, there's so many things that are record territory, off the charts, never been this high before.
Record debt, according to Nomi Prinz.
Record debt, absolutely. Yeah, you had Nomi Prinz on recently, and she's cataloging record debt around the world. And this isn't just a U.S. phenomenon, global. Huge amounts of debt and off-the-book liabilities as well. Of course, those don't get counted in any metrics usually, but you got your CalPERS in California underfunded to the tune of $95,000 per household. And we're just seeing records everywhere. And of course, the only way any of this makes sense is if the world goes back to super rapid economic growth. And that's been missing for 12 years. And you have to really believe some impossible things to think it's going to come roaring back at this time.
Chris, one of the things that you came up with a couple of years ago, and it just really stuck with me, and that was that there was this big of a pile, a little bitty inch high pile of real stuff, and there's a 2 foot high pile of paper claims against the real stuff. And for this fool, a lot of people thought this would go down, but they've rigged LIBOR, they've rigged gold, silver, they've rigged forex, they've rigged S&P futures, they've rigged commodities, they've rigged everything, they've rigged the world. Has that pile of stuff gotten bigger relative to the pile of the paper? Where are we now with the pile of paper relative to the pile of real stuff you could buy with the paper?
Well, this is a really important concept. I'm glad you're bringing it back up. It's really central to one of the core theses at Peak Prosperity, which is that there just has to be some sane relationship between the markers for wealth, the claims on the wealth, and the wealth itself. So the way we look at it is primary wealth. We'll break it into 3 buckets. Primary, the first stuff. Hey, that's rich farmlands. It's waterways that are clean and pure. It's ore bodies that are in the ground. If you happen to own acreage out somewhere with oil underneath you, you are an owner of primary wealth. Secondary wealth is what happens when people take that primary wealth. So the oil gets pulled out of the ground, it goes to a refinery, gets broken out into useful things like diesel fuel and gasoline and other things, right? That's secondary wealth. So that's the means of production and bringing things to market. Stocks, bonds, currency, derivatives. Those are all claims on these other things. And to make this simple, imagine you had $1 trillion of statements that said you owned stocks, bonds, currencies, things like that, but you lived on a barren, rocky island. You're still poor because if that island has nothing to sustain you, that primary and secondary wealth, well, then you don't actually have any wealth. So let's make this, that it's a rule we can make, which is if you don't have primary wealth, secondary wealth can't exist. And if you don't have these 2 forms of wealth, that tertiary, that third form of wealth, has no value at all. So there always has to be a relationship between the claims we're making and the amount of real stuff. For now, let's call the real stuff the GDP of nations of the world. And when you see the claims and GDP get really out of alignment, that's historically always resulted in the claims going poof. Now, that's happened lots of times in history. It's happened at the country level. Of course, Weimar Germany, we know about that. Zimbabwe, Venezuela right now. My argument is that the claims have been increasing at twice the rate, meaning these have been increasing at about 10%, and this stuff's only increasing at about 5%, and that's a problem. And it has been for a long time. That's what started to break in 2008. That's what the Federal Reserve said, oh no, we have to get back to how things used to be, which is a silly, mathematically idiotic place to be, which any 6th grader could work out for you, which is this. Greg, you can't grow your claims faster than your income. It's like saying, my credit card bill is going to double every year, but my income's only going to go up by half, right? It just doesn't, sooner or later you have a math problem. That math problem broke in 2008. We should have allowed that to burn itself out. We should have let Goldman Sachs go under. We should have let Citi go under. We should have taken our lumps, and we could have rebuilt from that point. But instead, what we have are these activist central banks that, as you mentioned, not only are they rigging everything, but they've allowed all this other rigging to go on of literally every market we've looked at. Because, why? Well, the banks rig stuff because they make money at it, but the central banks want that stuff rigged because it's a policy aim where they hope that if they can just increase the value of everything, that sooner or later the real economy will come and catch up and bail them out. Cool plan, but we have to ask what happens, Greg, if that plan doesn't work out.
And is that plan working out? I don't think that plan is actually working out.
Not so far. And we're 10 years into this. It's like, you know what? If they want to go into emergency measures in 2008 through early 2009, I'd be like, okay, whatever. You have to, it makes sense to try and engineer a softer landing. But if we look at the data, central bank printing has been driving up the asset markets. Those are the claims. 2017, you would think, now that you're 9 full years into your rescue efforts, that 2017, you would see the lowest amount of central bank stimulus, and instead we saw the largest amount. 2017 was the largest amount of money printing by the big three banks, which is Bank of Japan, Federal Reserve, European Central Bank, or the ECB. That was over $2.5 trillion printed in a single year. And people really ought to be asking themselves, what are they seeing that they're not telling us? Because they're saying everything's okay, but their actions say emergency.
Nomi Prinz, when you think about Nomi Prinz, who is a former banker, two-time best-selling author, I think she's going to go for a third time. But when she's never said this, that I'm going to tell people to do what I'm doing. I'm paraphrasing. You should buy metal. I mean, she didn't talk about futures. She didn't talk about stocks. She said, you should buy metal, especially silver. I love silver. What should you take away from a former big-time Goldman Sachs banker? I think she was at manager. I think she was at director level, at third level, pretty high up, real high up. What do you take away from that? Are you still into gold and silver? How do you interpret what she said? Yeah, I'm telling people to do what I'm doing. You should take money out of the stock market and buy metal. What do you say to that?
I'm a big believer in gold and silver, two separate words to me, different reasons and rationales why I own both of those as well. Maybe platinum, palladium, rhodium. There's some really great plays out there. And the reason I like them is because of that primary, secondary, tertiary discussion we just had, Greg, which is that to get gold out of the ground, for example, like when I was just at the Munich mining conference, and a lot of gold miners and silver miners, is uranium, all kinds of stuff going on. But when I talked to the gold miners and I asked them, hey, what's your average yield per ton right now? So a ton of rock has to come up out of the ground, get blasted out, crushed down into this little fine powder, and then you extract some gold out of it. And their yields are around a gram per ton, meaning that if you want to get one shiny 1 ounce coin right now, that has behind it, somebody had to drag out recently 32 tons of rock and smash it down and mill it and then extract the gold out of it. It's an extraordinarily expensive process. So I like things that are limited in supply, scarce, and which you can't print out of thin air. Now, look, we're coming at the tail end here, Greg, of the most outrageous period of monetary printing ever, which, by the way, is actually also a social experiment as much as it's a monetary experiment. Never been done before. Record high levels of debt, record high bullishness, record low yields on things. Right now, crazy. We're seeing Greek 2-year debt is trading with a lower yield than U.S. 2-year debt. It's crazy time. So when times are crazy, that's kind of like being at the blackjack table and you can't understand what's happening, but the person to your left is always winning or the dealer's winning and something's wrong. It's not adding up. Hey, grab your chips, go get a drink, right? That's kind of what it feels like right now. When things don't add up and they don't make sense, it's really time to just step back and be safe.
What do you make of this has gone on longer than a lot of people ever thought? I mean, a lot of people thought, and I mean good people. I mean, Paul Craig Roberts has said he's surprised. People like David Stockman, I've interviewed him, surprised it's gone on as long as it has. A lot of people are surprised this has gone on as long as it has. Are you scared, or are you shocked, or are you both about this scenario?
I am surprised, and I'm scared, and I'm shocked, and this is all three S's. This has been the reason this has gone on longer than I suspected, is because when I first analyzed this, there were a set of rules, and I thought we were going to stick to those rules. And not only did we not stick to the rules, but they didn't bother actually to rewrite the rules. They just changed them or didn't obey them. Right. So the Federal Reserve has done things that are not in the Federal Reserve Act, loaning $21 trillion to foreign banks. You can't find that in the 1913 Act, that's an okay thing to do. Right. And we know, Greg, that central banks are such heavy buyers of options and futures on the Chicago Mercantile Exchange that you can go to the CME website and find out that they have a central bank preferred buyers program. They get the highest volume discount. So central banks are buying as much of the levered products that, and at the CME, what do they trade? It's equities, bonds, commodities, right? So these banks are such heavy buyers that they have the best pricing program. Not one of them will admit that they own a single one of the products that are traded there. But we know they're in there and we know they're doing stuff. And so that's an example of how I think that they are changing and bending the rules. So then I think it's a legitimate question to ask. Hey, so if they're not going to follow the rules and they're just going to keep printing, this could just go on forever, right? Well, no, it can't, because, as Stockman will be quick to tell you, and as I've just tried to outline, there has to be a balance between your money and stuff. And you can, play, little magic tricks with that for a while, but eventually those two things correct. And here's my analogy for that. 2008, that broke. It wasn't just a housing bubble that broke. That doesn't explain why Greece went down. Greece had no exposure to the U.S. housing market. Something else broke in the system, and it was too much debt. That's the diagnosis, and the prognosis of the Federal Reserve was, well, we'll fix that by adding more debt, right? Crazy idea. And in 2008, I think it was kind of like we fell off a 6-foot step ladder, kind of painful. We picked ourselves back up. But in that moment, we should have allowed some of the bigger institutions that made really bad decisions. They should have been allowed to go bust. We should have allowed the debt to burn itself out of the system, and we'd already be rebuilding in a way that younger generations could believe in. Instead, the Federal Reserve tried to deny that reality and doubled down, worse, tripled down. And I fear, Greg, that it's kind of like we're now 22 rungs up an extension ladder. This next fall is going to be really scary to get to that second S. And I'm very worried that when that next fall comes, we're going to see the destruction of quite a few things that are really going to be very worrisome.
I want to just go on to one thing that I just want to bring up really quick, and that is what's it going to look like? Well, first of all, and I ask this question all the time, and just me personally, I don't get a good answer, but I think I will from you. I know your partner is Adam Taggart, and both of you are big writers, and you're at peak prosperity, and you're really for the little guy. You're really not peak prosperity for the bankers. You're for little guys. And you have a conference coming up in May. We'll talk about that too. I want to make sure I get that in there. But what does it look like for the little guy on the street when, not if, this is not an if, this is a when this blows up. Am I correct?
It's a when, as far as I'm concerned.
What does it look like for the man on the street? Already, I mean, the yield curve, a 10-year treasury is 2.6 something 2%. A 30-year is 2.89. We're talking 27, 28 basis points, 0.28, 0.27, 0.29. I mean, you're talking, I'd like to, let's see, hey, Mr. Banker, I'll buy the 10-year treasury here, 2.6 and change percent. How much do I get for holding it for 30 years? Oh, you get another 28 basis points. You get another less than 1/3%. I mean, what this is going to blow, correct? What does it look like for the man on the street? Two questions. This is going to blow, right or wrong? What does it look like for the man on the street?
Well, it will blow at some point. Look, recessions happen. They're supposed to be allowed to happen. The Federal Reserve and other central banks have decided to be very interventionist. They've decided they can eliminate the business cycle. You can't. The reason is that when things get really bubbly, people do dumb stuff with money, right? They do really stupid things that just there's no way for that money to be paid back from the investments that were made. It's called betraying capital. So, hey, that happens. The Federal Reserve thinks they can magically prevent that from happening. They can't. They don't have that engineering level. They've got just a giant lever that they pull. It's like more money into the markets. And so they go up. But what doesn't happen is better business decisions or better opportunities don't get created as a result. So this is going to blow. And you mentioned something that's really important, which is that we've had the 10-year treasury call it at about 2.6%, and the 30-day, 90-day, 1-year, 2-year, and 3- and 5-year paper, the other debt on the curve has been climbing up and getting closer and closer. Now, historically, every single time those two have become flat, the short and the long end, that's called a flat yield curve, and a recession has resulted. So recessions happen, and another one is going to happen because they happen. And we're really long in the tooth on this expansion, which hasn't really benefited everybody equally, as you know. So when that recession comes, what happens is the man in the street, two answers to that. One, for the person who doesn't have any exposure to equities, doesn't have stocks, doesn't have bonds. By the way, that's the majority of people in the United States and across the world, of course. For that person, they have to be ready for the next financial downturn to be kind of like 2008, but on steroids. This one's going to be multiplied by some whole number. So there'll be job losses. And for that person, I would say, get ready for that. Don't spend any money you don't have to spend. Get out of debt if you can. That's credit card debt, auto loans, whatever. And start saving money. And in particular, if you lose your job, don't make the mistake people made. A lot of people made this mistake back in 2007. They said, I lost my job, but I'll get one soon. And they kept their spending kind of level. thinking they would get a job soon. So they ate through their savings, and that was really a big problem for a lot of people. The second part is for the people who do have financial assets. You've got a pension, you've got a 401k in savings, you've got a stock portfolio, your own bonds, whatever that is. You have to be prepared for this next downturn when it comes. Adam and I both think it's going to be very, very rapid when it happens because we don't have people in these markets anymore. They're all computers. So the downturn could be very quick, could be very sudden, could be very hard to sort of escape for all those people who think they'll get out early. And so what we advise is, trim back your exposure, build up some cash instead. Just hold on to that cash. Keep it in treasuries if you want, short-term treasuries through Treasury Direct or some holding vehicle like that, or just build cash and keep that in a savings account somewhere. And then get a buy plan together. There are going to be great opportunities again, but as we started this interview, they're not out there right now. It's very hard to find good buying opportunities here. So, but there will come some. I think there's going to be some great ones in commodities. There's going to be some great ones in oil. There's going to be other sectors that will make sense to buy again, but we have to wait for that decline first.
Do you think that the dollar will hyperinflate to oblivion? I mean, a lot of people don't want to use it. They're doing yuan trade now, and they want to do yuan trade in oil. They haven't done it quite yet. They're doing it between countries like Russia and China. But anyway, what's going to happen to the U.S. dollar? I mean, should you save something other than just cash, paper money? Should you be saving gold, silver, diamonds, artwork, land? I mean, should you have other stuff?
Yeah, and cryptocurrencies are all extensions of way of saying I don't want my money in two things. I don't want it in dollars itself or in paper currencies. Like if I had yen, I'd get rid of all the yen. What a trash currency that's going to turn into. So that's one. And then two, people don't trust the banking system itself. Gosh, we've got all these bail-in rules now, and banks put themselves as senior creditors on the list during a bankruptcy, depositors at the bottom. Who knew, right? The so-called Citi Amendment to that act that happened a while back. So anyway, so people aren't trusting the system, and they shouldn't. I think there's reason to be cautious there. So with that, you do need to get your cash out, I think, as well. But holding cash for itself right now is okay. Now, when you talk about the dollar hyperinflating, we're really talking about it losing its value relative to real things. So a barrel of oil will still be a barrel of oil, but one day we might say, oh my gosh, it's $100 again. It's $200 a barrel. It's $300. It's $500. Oh my gosh. Price of oil is going so high. Nope, oil is still oil. What's happening is the dollar is losing its value compared to that. And so I'm reminded here of, when somebody asked Hemingway how he went broke, he said, slowly, then all at once. It's not a case of the US dollar losing reserve currency status like it happened some Tuesday at 8 in the morning. It's been losing its reserve currency status. It used to be about 70% of total reserves. It's down to about 62. China's walking away from it. They've struck bilateral trading deals with Russia, who's also walking away from it. And of course they are. Anytime a country seems to upset the United States, the Treasury Department exerts a very big stick, locks their banks out of the SWIFT system, and puts them into, it's financial warfare. It's been conducted against Iran, you name it, right? So for a variety of reasons, countries said, I'd rather not be subject to that if possible. So the United States is giving them a variety of reasons to walk away from the dollar. One being, we'll threaten you with it. The second being, hey, we don't trust how you guys are running your system over there. I mean, look what we just did. We just cut a huge tax cut, and that's going to really increase the deficit in this country. And the numbers they gave us all, Greg, are chump change compared to what they actually will be.
What do you think they'll actually be? They said $1 trillion. What do you say?
Double it or triple it because there's a recession coming at some point. So those numbers all include the fact that the United States never goes into recession, and it grows at a rate that it hasn't grown in 12 years.
So double or triple the addition to the debt. So instead of, they say it'll be $1 trillion, and they say it's dynamic and it won't really be that much, you say, it'll dynamic, all right. It'll be $2 or $3 trillion added to the deficit. It's going to explode. Is that,
yeah,
and that right?
Yeah, and you know what? That's kind of how it's always turned out. Take whatever numbers they guess and just multiply them by something, and you get closer to the truth usually. But their numbers are also insane for those two reasons I mentioned. They have a rate of growth that they assumed that we haven't seen in 10 years. So where's that going to come from? And secondarily, they say there's no recession in there. Recessions A single recession alone will make that a $2 trillion number. No problem whatsoever.
Go from 1 trillion to 2 trillion. And then the last thing, before we talk about your annual conference at peakprosperity.com in California, I'm bringing it up early. And the reason why is because if you want to go, you got to plan for this kind of stuff. But last question, what about the war card? I mean, could things get so bad that somebody makes a mistake, or somebody makes a mistake on purpose, or there's a false flag, or just whatever reason? Could the war card be played on either side of the Atlantic, either side of the Pacific?
Well, absolutely. I don't think the risk of war has been higher in my living memory. It's geopolitical tensions are high, but remember, almost every single war in history has been a resource war at heart. And I wrote a really important article last year, and it talks about the fact that China is fully aware of the fact that its own oil output is peaking this year in 2018. And they know that their imports of oil are going to double over the next 10 to 12 years. Spoiler alert, there isn't enough oil available for export for China to do that. So how does that get resolved? Well, either with wicked high prices or with a war. And those are the two ways those things have been resolved historically. So that just bears watching. And of course, I think people need to be prepared for that. When you ask what could end this, it's the price of oil to me is the most likely thing that's going to come along and be the pin that finally pricks these bubbles. No central banker is going to do it. They're deathly afraid of these markets they've created. They freaked out twice in 2016, as a consequence of the Trump election, plus some weakness that was happening in the markets. Both times they called each other and just dumped more money in the markets. So they're afraid of a downturn in the markets. They won't willingly go there. So what could force that is the price of oil. That is the new Fed funds rate, meaning a higher price of oil is going to really harm some of the weaker players out there, which could be a weak country, a weak entity, weak families, doesn't matter. That's how these things start. The chain reaction always starts with somebody not being able to pay their debt back.
And you say the big thing to watch, oil.
Yes.
At what point do you think it starts getting freaky and goes off the rails?
Well, of course, any event like the closing of the Strait of Hormuz and pick a number, 200, 300 a barrel, something happens. But barring that, it is still below the marginal cost of production right now. Nobody's firing up any brand new big ultra deep water or deep water plans at this point in time because they need $80, $90, $100 a barrel to make that stuff work out, depending on the play. So guess what? There's been about $1.4 trillion of investment that hasn't happened in the last 3 years. And this is the most shocking statistic I have about oil. 2015, one of the worst years ever for discovery of new oil. 2016 was worse than that. And 2017 was worse than that. In the entire series of oil data that I have, which goes back to the 20s, there's never been a worse 3-year period for oil discovery. That means that 3, 4, 5 years after that, when that oil was supposed to be coming out of the ground, it won't be there. And it doesn't matter how much you spend. There's just a lag that oil takes time to get out of the ground once you have a discovery. So people really ought to understand 3 terrible years of oil discoveries is going to create a supply problem in the future. China's on that like a laser. They get it. You've seen the really remarkable and dramatic shift of Riyadh, Saudi Arabia, first visiting Beijing, China in May of 2017, and then Moscow in October 2017. Huge geopolitical realignments there. That really, people, if you don't understand the oil story, you're like, oh, Saudi Arabia, what are they doing? You got to understand the oil story and how everybody's positioning around that. I kind of think my country's sleepwalking right now. Moscow isn't, Beijing isn't.
I want to talk about your conference, Peak Prosperity Conference. It's in May, but you told me about it, so we need to talk about it now. People need to make plans now. It's in May in California. Can you talk a bit about that?
Sure. Once a year we have a conference. Now, everything you and I have been talking about is problem definition. The big question is, well, what do I do about that? That's what the conference is about. It's solution space. We spend 3 days doing that. It begins May 4th, which is a Friday, and then also Saturday and Sunday. It'll be Adam Taggart, myself. We've got some special guest stars coming in to talk with people, including Charles Hugh Smith, who writes for himself, for us from time to time. Great guy. And we've got Richard Heinberg, who wrote about peak oil and all of that. And we've got the fire marshal from Santa Rosa, who was there, talking about community resilience in the face of those absolutely devastating fires that just came through last fall. in that part of the world, and somebody from Singing Frogs Farm, Paul, and hopefully Elizabeth Kaiser, coming to talk about one of the most dynamic small farms that we've seen. They make a ton of money per acre, and it's just astonishing how well they do that, and they do right and do right for everybody. So this is the kind of area we are going to talk about. And this centers, Greg, around our book, Prosper, which talks about 8 forms of capital. Money's one. We center on that one a lot, but there are 7 other forms of capital, like living capital, social capital, knowledge capital, and your emotional capital, things like that, which we think if you're rich in all 8 forms, no matter what future comes, you'll be prepared, but your life will be better today. So we don't do greed and fear. We're just very, here's the data. What are we going to do about it? That's what the conference is about.
A lot of people. One more question. I'm going to tack on one more question. A lot. And is this on your website, peakprosperity.com?
It is. You can get to it, peakprosperity.com/seminar. You will find it there, and we've got banners around that, so very easy to get to.
I'll put the links up, too. I'll put direct links up in the after interview. You'll send me some of those links.
Thank you.
It'll also be in the, for you people watching this on YouTube, just go up to the About section where I do a right through, and it says all links are found on USA Watchdog. Boom, go back. You'll find the links on the after the interview section. And one last thing, a lot of people just think that that central banks can keep these plates spinning, with the sticks up in the air forever. They just think, hey, they can print money forever, they can keep it spinning forever. Can the central banks just keep this printing and the plates in the air suspended forever?
Well, if to believe that, you have to believe an impossible thing, Greg, which is that you can print your way to prosperity. It's never happened for anybody before. My theory is that if you could, we'd all be speaking Latin because the Romans would have worked it out, right? Super clever people. We can still drink from their aqueducts and drive on their roads. Try that with a New York City subway, aqueduct system or roadway, right? So people have tried this over and over again, and it centers on the biggest falsehood there is, which is that the central banks are in charge of helping us create wealth. They don't. They redistribute wealth. Real wealth comes from people like you and me and your listeners doing real things, performing real work, and transforming goods and services and adding value. All the central banks do is make numbers go up, and actually they're just transferring money away from this group and giving it to that group. And you've seen it. They've taken it from the middle class, the students, the young, the poor, and they've transferred it to the 0.1%. And that is a gigantic mistake that they've made.
Didn't the 1% get 80-something% return or 80% of the returns this year? Did you in the pre-interview? Did you tell me something like that?
Yeah, of the wealth that was created. Remember, now this is wealth. It's tertiary. It's not actual wealth. So we call it wealth. So let's be clear. Of the paper wealth that was created this year, 80-some% of that flowed to the 1%. And so it's a highly, when I said earlier, the central banks are conducting a monetary experiment. Hey, if we do this, oh, look, the rich get richer. It's also a social experiment. So if you want to understand Catalonia, Brexit, the election of Trump, and other things like that coming, you need to understand that when things are unfair, people get unhappy. And that's starting to show up.
Chris Martenson, again, when is your seminar is in May? You have a date for it?
Yes, that's May 4th, 5th, and 6th, Cinco de Mayo. We're going to be in Sebastopol, California. It's beautiful there that time of year. So if you want to come to the seminar, but maybe you have somebody else you want to bring along who maybe doesn't want to go to the seminar, hey, Heart of Wine Country, go visit the Redwoods, check out the coast, take a wine tour. Lots to do there. So it's just a great place to be.
Where do you fly to, Sacramento or San Francisco?
San Francisco's great. It's, about an hour drive from there, or you can hop in from there to the Santa Rosa airport, but a lot of people will be coming in through San Francisco.
Okay, and it's all on your website, peakprosperity.com. Tell Adam Taggart I said hello. He's a smart guy.
Will do.
Chris Martenson, thanks for coming on USAWatchdog.com and showing off your brain with your article about let me get this right, about believing you have to, oh shoot, here we go. I got it. I'm going to get it. Don't worry. Believing the impossible. Yes, I'm sorry. I can't see anymore. I'm old. Believing the impossible, which is pretty unbelievable. What a great article. Everybody should write it. Everybody should read it. Everybody should go on. It's a very long article. Very long. And we just skimmed the surface. But go on, peakprosperity.com. All the links will be in the after the interview section. Chris Martenson, thank you so much for being on USAWatchdog.com.
Greg, it's been my pleasure.